Good morning and good afternoon. So this video will be on weekly bias, like as the previous video was on daily bias. So first and foremost, it's currently raining outside, but so the sound might be distorted because of the noise outside from the rain and other machineries that is operating outside. But I want you to focus solely on my voice. Ignore those sounds outside as take them as distractions. So you have to focus on my voice. Understanding where the weekly candle, the weekly power of three is likely to draw to next. Let's say for a bullish narrative, for a bullish week, we're expecting the opening price for the weekly time frame is the Sunday's opening price. So on Sunday, you want to note that opening price. You want to note where you have your opening at Sundays. So Sunday's opening price that is at 6 p.m. The opening price at 6 p.m. So that is the true opening price for the week, not Monday's trading. It's the market starts trading on Sunday's Sunday's evening. So during this time, if you are expecting a bullish week, if you're expecting for example, using a bullish sentiment, a bullish narrative, if you are expecting a bullish week, first you would expect price to offer lower prices because that opening price on Sunday is fair value. Fair value being it is not too cheap and it is not too expensive. It is a fair price which you are willing to pay. That is the Sunday's opening price. So Sunday's open is fair value, it's the true opening price. So because you're expecting a bullish narrative, because from looking at order flow here from the weekly, it's clearly bullish. So you are not expecting every drop in price. You are seeing that as price going to take out old lows to trade higher. So we are not trying to pick tops in bull markets. This is why we are sticking to a bullish narrative also going into this week. And from order flow, this imbalance here is seen as a breakaway gap. So you do not want to see this imbalance being filled. So to understand how to read the weekly order flow, you must understand the concept of institutional order flow. In reading institutional order flow, you read it the same way you read the way you read your 1 minute chart, the way your 1 minute chart prints, that same way that you read it, that is how you are going to read this institutional order flow on these time frames, on this 1 week, on this weekly time frame. So back to it. So after you have that Sunday opening, then on Mondays, Tuesdays, and Wednesdays trading, you're expecting a drop in price to offer an oversold condition to bring in sellers at lower prices. So sellers will come to sell that asset class at a lower price, and you, with your anticipatory skills, because you are anticipating a bullish weekly candle, so you are looking for PDRAs above the current market price to for price to trade to it and through it. So what is the most obvious PDRA we have here is this buy side liquidity. So above this swing point, we have buy side liquidity resting above here. All right. So this is it. So when you have your weekly draw already all outlined, then you drop down to the lower time frames. So we just go straight right into it. So let's go to the 1 hour time frame. I implore you to look at your daily time frame to understand the intraday trading that went on Monday's trading, and that is currently going on today being Tuesday's trading. All right. So let's get right to it. So you're prompt to note the Sunday's opening price. So on Sunday's open, that is at 6 p.m. when the market opens on Sunday, you have this here. So let's make this a gray color. So here is this Sunday's open, which is fair value. So here is Sunday's open. And as you can see, after price chopped around the Sunday's open, price trades higher here and then dropped lower on Monday's trading. So when we have something like this now, price is currently below Sunday's opening price. Yeah, price is currently below Sunday's opening price. So you expect the low of the week to form on Monday, Tuesday, or Wednesday before the Wednesday's New York session. That is when the low of the week, if you're expecting bullish weekly buyers, you're expecting the low of the week to form from that Sunday's trading, from that Sunday's open to the Wednesday's New York session, to the New York morning session. So the low of the week should form before that, within that time frames, within that time frame. For a bullish weekly profile, we're expecting the first half of the week to be opposite in line with, it should be directly opposite to the buyers, to your buyers. So if you're expecting higher prices, you're expecting price to first offer lower prices. This, when prices dropping lower, offering lower prices, this will be seen by the uninformed, the speculative uninformed money. They will see this as price making lows, making new lows. But as smart money traders, we already know that when price goes to a lower, when price goes below the current market price, price is going there to seek a discount price, to seek discounts in the marketplace below fair value. So that is what we are there on Monday's trading and also Tuesday's trading. Now, even though it is a bullish week, from the economic calendar, you couple this with your economic calendar. So from the economic calendar, we have a market profile that will be a choppy week, but a bullish choppy week. So it will be chopping higher. Now, we indicated that the low of the week typically forms within the Sunday's opening price to the Wednesday's New York session, New York morning session, right? So we are expecting the weekly profile, the weekly power of three should form something like this. So you have the Sunday's open. So you have the Sunday's open here. This will be the Sunday's opening price, and then price will trade below it to seek discount, to go into an oversold condition. So you see, you do not need any indicators to determine, to understand when price is currently in an overbought or an oversold scenario. So this is what we have here. So when we have this open price, then price will drop lower. I'm not currently calling for the low of the week. I'm just using this as an illustration. I'm using this week's trading as an illustration. So when you have this price drops lower, when price goes lower like this, smart money traders, the algorithm will be bringing in sellers at a lower price. So they'll be entering their sell position, sell, sell, sell. Does that make sense? The algorithm now will use these sell orders. When price was dropping here, the traders that were entering sell positions, the algorithm will use smart money buy entries as a counterparty to these sell orders. So there will be, as smart money traders are entering their buy orders, the uninformed are entering their sell orders. So that is what makes the market a balanced market, because it is efficient for smart money to use the liquidity of the uninformed money to use as a counterparty for their own interest, for their own buy interest. Does that make sense? So you have price making this low like this, and that making it low of the week on Tuesdays or on Wednesdays trading. Specifically, like to be more precise, the low of the week generally forms within Tuesday's morning, sorry, between Tuesday's London session and Wednesday's New York session. So we are now pinpointing where we expect the low of the week to form. So we expect the low of the week to form within these time frames, within these time windows. So that is where you have the higher probability of the low of the week to form. All right. So when price is currently below a Sunday's opening price, let's say hypothetically you are entering before Wednesday's trading. So if you're entering on Monday's trading, you would want your drawn liquidity, your first target, to be the Sunday's opening price, because price will trade to that Sunday's open to seek fair value, because price will trade to that Sunday's open because that is a significant price point. So if the low of the week is forming on Monday's trading, because you do not know when Monday's trading is printing at that moment, you do not know for a certain that is the low of the week. So hence, your first, you must take something off at the Sunday's opening price. So that's that same mindset. That is how you operate when you're trading on Tuesday's trading. Also, you expect, because our draw on liquidity for the week, for the weekly draw, is this buy side liquidity from the weekly time frame. We're expecting an expansion leg higher to take price higher for higher prices. You do not expect, you are not concerned about the top, where the highest high of that expansion leg will take you to. You are only concerned with capitalizing on the expansion leg. So you have an expansion leg, something like this, higher. So you are interested in capitalizing on this expansion leg. Your best fills will be formed below the true opening price, which is this Sunday's open. That is where you get your best buy entries. So your best fills will be at below this Sunday's open when you're expecting a bullish expansion in a weekly candle. And another thing, on Wednesday's trading, after the New York session, if we get to leave this Sunday's opening price, this true open, if we get to trade above it, you do not want to see price come to it or below it again, because price has already spent a lot of time at an oversold condition, and the algorithm does not stay for too long at oversold conditions, because the algorithm cannot wait for anybody. It doesn't wait for anybody. So when you get the opportunity, you strike while the iron is hot. So once you see the algorithm making the low, when you see it making a low and your model forms, you get your model, you engage in price, expecting price to draw to your intended draw on liquidity, which is this buy side liquidity. But you do not expect this buy side liquidity to be reached for it to be profitable. You are more interested in capitalizing in this expansion leg, which will form, there will be an expansion leg just above the Sunday's opening. So your best fills for buy will take place below this Sunday's opening price. Then price will rally higher through Tuesdays, Wednesdays, and possibly Thursday's trading. So you are not concerned with where the market will close. There are tools to allow yourself to understand the exact market close, but you are not concerned with that. You are not, to obtain profitability, you are not concerned with that level of perfection. You are only concerned in capitalizing on that expansion leg, taking your pound of flesh and dip. All right. So how do you use this information? So today is currently Tuesday's trading. Let's say we are trading this session, this morning session, this New York morning session, how do you use this opportunity? So you can use it as a swing trader, and you can also use it as a scalper, because this current mentorship now is more focused on scalping. So say you are using this weekly draw on liquidity, you are using this weekly bias to trade the lower time frame. So when you have something like this, so you have this sweep, you have this purge of sell side liquidity here. So we label here sell side. So sell side was purged here. So you're expecting price to go for buy side above these highs here, the Sunday's open, this high, and also this high here. So you jump to a bellwether time frame, which is generally the 15-minute time frame. The 15-minute time frame will give you everything you need to engage in a body of price action. Everything you need, the 15 minutes will present itself to you. All right. So on the 15-minute time frame, say you are currently at 9:30's trading. Yeah, you come to the marketplace doing the equities open, which is this 9:30's trading, where price has taken out these lows. So you see this back and forth price action. This is an indication of damage is being done. So when you see something like this, when you see a back and forth price action like this means damages have been done here. There are traders that have been trapped here. There are traders that have been stopped out around this place. So what happened next? You have an expansion leg higher. So when you get this expansion leg higher, price leaves this order block, this last down close candle. So as you can see, after this expansion leg, price comes down to trade to this 15-minute order block. So the eye of this candle. So price trades back down into it. So let's make this green. Let's make this green. So if you go into the lower time frames, you see the precision techniques on how the market seeks this order block and uses it to take price higher. So you had price trade above these relative equal highs here for buy side, because buy side was resting above here. This is what I was explaining earlier. You do not need the weekly draw on liquidity to be reached for you to be profitable. You can capitalize on the expansion leg going towards that Sunday's open and the buy side liquidity target. You can capitalize on that move to be profitable. You do not need this to be profitable. All right. So for the market review, we have this. So you have the midnight opening price here, and then you also have the 8:30 a.m. open. So from the weekly time frame, so you have the weekly power of 3 printing out, and then you also have the daily power of 3 on this daily time frame printing out, because price is fractal. What goes on in the higher time frames repeats itself in the lower time frame. It's a fractal. That is the fractal nature of price. All right. So you have price drop below here. This is the Judas swing. When price was dropping below this, when price was dropping here, this is a Judas. You anticipate this Judas because you're expecting price to go for sell side liquidity below old lows to pair in smart money buy entries. Does that make sense? So you can buy below this low if that is your model. You buy below old lows, but that model is more, it's a very challenging model, especially when the trader is a brand new trader and hasn't find trust in himself as much as he would like. So if you are that kind of trader that you need more confirmation in price, you wait for an expansion leg, because after price creates this sets of down close candles here, price rallies higher. Yeah. So after it does this here, you're expecting price to trade to this, to the eye of this candle again. So because you're expecting price to trade to the eye of this candle, your entry can be this order block here. So you're buying from this order block, taking something off, above this buy side liquidity, and also at this Sunday's opening price. Because it is not Wednesday, it is advisable to take most of your position off at this Sunday's opening price, because price can still reverse lower to take out this Tuesday's low, before going higher again for this John liquidity, which is 5669.8. All right, so that is it. So I'll jump to the 1 minute time frame. I'll jump to the 3 minute and the 1 minute time frame. So you look for yourself, go into the marketplace and study this profile, this weekly profile, coupled with the current daily profile, to understand if you were a participant in this body of price action, what would you have done? What were the steps that you would have taken to align yourself with the market? And also look for entries, practice entry models that aligns with your own personalities. That way you can understand how you are to engage in the marketplace when you have already understood how to read the higher time frame order flow, because that is the main important thing, to understand where the higher time frame is likely to draw to next. The entry point is the least of your worries, because you can enter with any form of entry. You can enter with a stock to soup entry drill, you can enter with an OTE pattern entry, you can enter from a order block, you can enter from a fair value gap. The entry patterns do not matter. What matters more is you understanding where the market is likely to draw to next, which generally most ICT traders that understand what language we are speaking, they get to understand that first quickly, easily, because they understand that we are trying to predict the future of a asset class. We are not here to react to it. We are not trying to react when price goes higher. When price trades above this Sunday's opening price, we are not trying to react and buy, because when price has gone above this Sunday's opening price, it can be an overbought condition. Let's say in a bearish scenario, so it can be at an overbought condition. So you want to align yourself with where price is likely to draw to next. When you align yourself with that, you can capitalize on that move in an intraday trading or in a short-term scalp. Because say you buy from this bullish order block here to this buy side liquidity here. Say you buy here. This is about 20 handles. 20 handles is enough for you for the week. If you're trading the E-mini S&P, getting 20 handles in the week is doable, and it is enough for you to stop trading for the whole week, because you do not want day trading to be everyday trading. You are not here to be an everyday trader. You are here to make money and go about your day, get done with business, start new businesses, get new hobbies, and so on and so forth. So I gave an assignment, and this is currently the review of the assignment, and this right here is currently the in-depth review of the assignment, because you are told to identify where you would have participated in a marketplace in a weekly profile that is bullish to you. You are giving the buyers for the week, you are giving the buyers as a bullish bias. You are not told the exact point on the Telegram group. You are only giving an hypothetical bias that is bullish, and you should identify the weekly power of 3, which we did here already. So the power of three has already been identified, and everything you need uh, from the assignment, the answers to the assignment has already been revealed currently here in this video. So I hope you got something from this video. And the last part of the assignment is for you to, using what has been explained here in this video, from the beginning of this video to this current point, using this, you then coupled with the economic calendar, how would you have engaged in the price in the marketplace, and how would you have identified the low of the week when the low of the week does form, whether it is this Tuesday's low, or you're expecting from the economic calendar, you're expecting price to trade lower to take out these lows, also preventing these buyers now from profiting from this move to this high. So you use the economic calendar to do that for yourself. That is for your own study. All right. So I'll talk to you in the next video. And thanks for watching. And goodbye and good trading.